joining us now on set, we've got Brian Levitt. He is the global market strategist over at Invesco. And Brian, it's great to have you in studio with us. Thank you so much for coming in. I do want to start a little bit more broad, and then of course we'll get to Nvidia. But we saw that huge post-election rally in the market, and then it's coming in a little bit. How are you thinking about where we kind of land after all of that volatility?
Yeah, we saw that in 2016 when Trump won as well. You had a pretty big move in cyclical stocks early on, smaller capitalization, and it didn't sustain. And so the challenge is the hope of Trump is higher nominal growth because you're going to get tax cuts and deregulation. But then on the other side of that, it's a little bit of a Rorschach test because you've got uncertainty around trade and industrial policy and fiscal consolidation. Those things tend to be more of a headwind to growth. So what do you do about it? I mean, I'm not going to interpret a Rorschach test. I interpret what I always interpret, and that's leading indicators of the economy, which are generally stable, but not really pointing to above trend growth. And the Fed's kind of scaled back their expectations for rate cuts. So to me, that's not consistent with a higher nominal growth environment. It's fine for markets. Right? It should be fine. But to me, that still favors more higher capitalization, quality, rather than the so-called Trump trade.
So talk to me a little bit more about it being fine for markets. I guess, what does that then look like?
No, it's a good backdrop for markets. I mean, people are focusing on, well, will there be volatility? We've had such a nice move. Yeah, if you get policy uncertainty, like we had in 2018, uncertainty around the trade war, we did have to take a leg down. But the backdrop for markets still looks quite good. I mean, we're beyond inflation. We're beyond tightening. I think over time, the 10-year rate will come in a bit. So all of that is a good backdrop, decent enough nominal growth to support corporate earnings. So I think stocks go higher. I think we have the so-called Santa Claus rally. I think stocks go higher in 2025. But you do have a little bit of policy uncertainty that could, in the short term, create the market volatility that investors have been, maybe waiting for. I think they're always waiting for it, actually.
Yeah. Well, you said something really important there, which is that, we're beyond inflation. And I wonder if we can stick on that idea.
Yeah.
Are we definitely beyond it, especially given incoming tariffs?
Yeah, so we are certainly beyond it right now. Now, people will throw things at me when I say that because they're talking about the high cost of living. I'm talking about what the Fed's focusing on, which is the rate of change in inflation, which is back in the comfort zone. Interesting thing about tariffs, we know that tariffs can create less optimal economic outcomes. Currencies tend to adjust, so it probably does mean a bit of a stronger dollar. And I would view where the consumer is right now as tariffs perhaps being a little bit more of a tax on the consumer rather than the beginning of a next stage of inflation. The reason we got inflation is because we responded with force to a pandemic. Everyone had money in their pockets, but the supply chains weren't open yet. That was why we got inflation. I don't think we're going back to that environment. And given where the consumer is now, I think the tariffs are going to be a little bit more of a tax than the beginning of the next stage of inflation.
Yeah, that's interesting. And I also think it's a different perspective because we've heard very much maybe more of the concern about ultimately what that's going to do to complicate the Fed's fight to tame inflation. Brad, how closely, or I guess how much does it matter in terms of the pace of those rate cuts, right? There's lots of debate about whether or not we're going to get an additional 25% or 25 basis point cut, next month. And then looking ahead to 2025, what's baked into your forecast at this point?
I think what matters with the rate cuts is market leadership more than whether the markets can continue to do well. Because every time the market gets the sense that rates have to come down rapidly, you get a nice small cap rally, right? You get economically sensitive parts of the market doing really well. And then when you price that out, you tend to get a shift more to higher quality and those types of businesses that don't necessarily need the rate cuts. Ultimately, I think we've got to at least get to neutral. Now, people will quibble what that is. You want to call it 3.5, you want to call it 3, whatever. We got to get to neutral. The larger question is, do we ever need to get to accommodative? And the market, not that long ago, was thinking we needed to get below 3. I would categorize that as accommodative. Now the market's in the more mid-3s, so I would consider that more neutral. But the Fed's going to go at a slow pace. I don't think market leadership's going to change all that much. It's still going to be quality cash flow generating businesses.
It brings me to a point that I've heard you bring up before, Brian, this idea that you only have to really question it if it's going to impact growth or impact the movement of the Fed.
Yeah.
Where does Nvidia fall into that? Does Nvidia really have the chokehold over the market that we all say that it does, given that the Fed isn't really going to care what happens tonight?
Yeah, Nvidia is has a large position in the S&P 500, so it can move the markets one way or the other based on whether it disappoints or surprises to the upside. But I would view that as a couple a day thing in the market. I wouldn't view that as what that means for Nvidia or the S&P 500 over the intermediate term. You have to remember, these are businesses that are investing heavily in what they believe and what we all believe is a structural trend. So quarter to quarter, depending on the timing of it, you could see the investment show up but not the delivery show up, and vice versa. So you may get whipsawed a bit, but the demand for Nvidia chips going forward is likely to continue to be strong over the intermediate term until, the moat around their business or other competitors start to emerge. So that's a very good intermediate story. If I'm an investor, I am an investor, don't allow yourself to get too concerned about the move one way or the other the day after Nvidia reports.
Brian, what's your read just more broadly about the AI trade and AI momentum going into 2025?
AI trade is largely rewarded those who are going to bring us AI. It's largely rewarded, the chip manufacturers, software providers. I don't even believe this market has begun to consider the productivity gains, the efficiency gains downstream. I'm even using it already. I'm probably using it to the extent that I'm going to take myself out of a job, but I am, it's recording podcasts for me, it's editing my commentary. So this is going to be a long structural trend. There will be winners downstream. I think the market is not even considering. For the largest names, again, I think intermediately, they're well positioned. Over the intermediate term, they're well positioned. There's going to be quarters where investments and deliveries may misalign, but this is a long-term story, and many of those companies have nice moats around their businesses.
All right, sounds like ignore the noise heading into tomorrow at least. Brian, thank you so much for joining us in studio too. We really appreciate it. Brian Levitt over at Invesco.